Every price movement, from the smallest intraday fluctuation to the largest multi-decade secular trend, is a direct and unfiltered expression of the shifting balance between these two opposing forces. The genius of the market's greatest operators was not in their ability to predict the future, but in their ability to read the present with unparalleled clarity. They learned to filter out the noise and focus on the one true signal. One man, more than any other, dedicated his life not just to mastering this skill, but to deconstructing it into a logical, teachable framework. His name was Richard Wyckoff, and he was the man who found structure in volatility. This is the story of the universal law that governs all markets, and the observer who dedicated his life to decoding its language for the benefit of all who would listen. To comprehend the Wyckoff Method, one must first build an unshakable foundation on the law that underpins his entire philosophy. The law of supply and demand is a simple concept that dictates the price of everything, from a loaf of bread to a barrel of oil. When demand for an item is greater than its available supply, the price must rise to ration that limited supply among the eager buyers. Conversely, when the supply of an item is greater than the demand for it, the price must fall to entice new buyers and clear the excess inventory. This is the fundamental, unchangeable physics of any free market. The stock market is no different. A share of stock is a commodity with a relatively fixed and known supply, the number of shares outstanding, and a wildly fluctuating and unknown level of demand. It is the constant, real-time battle between the owners of those shares who wish to sell them, representing supply, and the prospective buyers who wish to own them, representing demand, that causes all price movement. This is the most critical and often misunderstood concept for any market participant. A stock's price does not rise because the company released a good earnings report. A stock's price does not fall because of a negative news headline or a geopolitical event. These external events are meaningless in a vacuum. They function only as catalysts that influence the perceptions and therefore the actions of human beings. A great earnings report only causes a stock's price to rise if it convinces a new wave of buyers to enter the market with enough force to absorb all the shares being offered for sale by existing owners. If, however, the large, informed operators had anticipated this good news and used the public's excitement as an opportunity to sell their large positions, the sudden influx of supply can easily overwhelm the new retail demand, causing the price to fall. This is the classic sell on the news phenomenon that baffles amateurs. They see good news and a falling price and conclude that the market is irrational. Wyckoff would argue that the market is being perfectly rational. It is simply telling you that, at that price level, the supply of shares for sale is greater than the demand to buy them. The news was merely the context for this transaction. The only place where this real-time battle between supply and demand is recorded with perfect fidelity is on the ticker tape through the objective data of price and volume. Wyckoff's entire life's work was dedicated to teaching traders how to read it. The man who would become Wall Street's foremost educator on market structure began his career at the absolute bottom of its hierarchy. Born in 1873, Richard Wyckoff started his journey at the age of 15 as a runner for a New York brokerage firm in 1888. This was not a privileged entry into the world of finance. A runner's job was to physically carry stock certificates and checks between brokerage offices and the stock exchange floor. This ground-level position, however, gave him a unique and invaluable vantage point. He was not isolated in an office reading curated reports. He was on the front lines, observing the raw flow of orders, witnessing the panic on the floor during crashes, and feeling the palpable excitement during booms. He saw firsthand how the small individual investors, whom he called the public, were consistently and systematically outmaneuvered by the large, informed operators and powerful financial syndicates. As he rose through the ranks from runner to head of his own brokerage firm, this initial observation grew into a lifelong mission. He saw that the public was at a constant disadvantage because they were playing a game without knowing its real rules. They were trading based on tips, rumors, emotions, and superficial interpretations of the news. while the successful professional operators were acting on a deep, analytical understanding of the market's internal mechanics. Wyckoff was a highly successful trader in his own right, reportedly amassing a significant fortune through the application of his own developing methods. But his ambition was greater than personal enrichment. He sought to codify the unwritten rules of the game, to take the intuitive methods of the market's greatest winners and deconstruct them into a logical, teachable science. He wanted to level the playing field. To this end, in 1907, he founded the Magazine of Wall Street. Under his leadership as editor and publisher, it became one of the most influential financial publications of its time. The magazine was his platform for this educational mission, a place where he could dissect market campaigns and share his insights on how the smart money operated. His work culminated in a comprehensive trading course that he began selling in the 1930s, a synthesis of a lifetime of observation, analysis, and personal application. Wyckoff's approach was that of a journalist and a detective. He believed that the best way to understand the market was to study its most successful practitioners. His position as a prominent editor gave him unparalleled access to the financial giants of his day, and he used this access to conduct a multi-decade study of their methods. He interviewed and analyzed the strategies of legendary financiers like J.P. Morgan and James R. Keene, a legendary stock pool operator. He sought to understand how these men used their vast resources to engineer market campaigns, accumulating huge lines of stock at low prices, and then methodically distributing them to an excited public at high prices. From these titans, he learned the importance of seeing the market as a series of planned campaigns, not random fluctuations. Chief among the operators he studied was the man many considered to be the greatest natural tape reader of all time, Jesse Livermore. Wyckoff was fascinated by Livermore's almost supernatural ability to read the market's intentions and anticipate its major moves. He saw in Livermore an intuitive genius who could feel the market's pulse and act with decisive, profitable courage. Wyckoff's goal was to take that intuition and reverse engineer it, to break it down into a set of logical principles and indicators that any intelligent student could learn. Wyckoff's study of Livermore was intense, and he even published analyses of his methods. The psychology and raw market feel of this legendary operator are best understood through Edwin Lefebvre's Reminiscences of a Stock Operator. This book is essential for learning about the speculative chaos that a disciplined system like Wyckoff's is designed to filter out and control. To help you absorb its timeless lessons, we have linked in the description a unique, chapter-by-chapter analysis by Max Davidson, specifically designed for the modern reader. Through this intense study of the market's masters, Wyckoff developed the core concepts of his methodology. His first and most important innovation was a heuristic, a mental model for simplifying the seeming complexity of the market. He called it the Composite Man. Wyckoff urged his students to view all the chaotic activity in the market as if it were the actions of a single intelligent entity. This composite man, he explained, sits behind the scenes, manipulating the market for his own benefit. He is shrewd, patient, and logical. He carefully plans and executes his campaigns, accumulating his position when the public is pessimistic and selling it when they are euphoric. The value of this metaphor is immense. It transforms the trader from a passive victim of market whims into an active analyst, a detective trying to decipher the composite man's intentions. It allows the trader to ask simple but powerful questions. What is the composite man doing now? Is he accumulating shares in this price range, or is he distributing them? What is his next likely move based on the evidence on the tape? This mental model is the key to unlocking the Wyckoff method. It provides a narrative framework for interpreting what would otherwise be a meaningless series of price ticks. From this central metaphor, Wyckoff articulated his three fundamental laws of market action. These laws are the logical rules that govern the composite man's behavior and provide the basis for all of Wyckoff's analytical techniques. The first law is simply the law of supply and demand, which we have already discussed. For Wyckoff, this was the ultimate truth. The rest of his method is simply a set of tools for analyzing this single dominant law in real time. The second law is the law of cause and effect. This law posits that nothing in the market happens without a preceding cause. A major uptrend, the effect, must be preceded by a period of accumulation, the cause. A major downtrend, the effect, must be preceded by a period of distribution, the cause. Furthermore, the size of the effect is directly proportional to the size of the cause. A long and arduous accumulation phase, where the Composite Man patiently absorbs shares over many months, builds the potential for a long and sustained uptrend. A short and hurried consolidation, by contrast, will likely only lead to a minor move. This law is crucial because it provides a method for gauging the potential of a trade. By analyzing the duration and intensity of the cause, the consolidation phase, a trader can make a rational projection about the likely extent of the subsequent effect, the trending move. This transforms trading from a blind gamble into a probabilistic exercise based on observed evidence. The third law is the law of effort versus result, which is Wyckoff's most nuanced and powerful tool for real-time analysis. This law states that the volume on a price chart represents the effort being put into the market, while the resulting price movement represents the result. In a healthy trend, effort and result are in harmony. For example, a sharp increase in volume, the effort, should lead to a significant move in price in the same direction, the result. This harmony confirms the health and validity of the trend. The most valuable signals, however, come from divergences between effort and result. For instance, if a stock experiences a massive surge in volume but the price makes very little upward progress, it is a sign that the huge effort is not producing the expected result. This divergence is a major warning sign. It suggests that a large, hidden supply of shares is entering the market, absorbing all the buying pressure. The Composite Man is likely distributing his shares. Conversely, if a stock is drifting lower on extremely light and diminishing volume, it signals that the selling pressure, the effort, is exhausted. This lack of supply means that even a small amount of new demand could easily push the price higher. By constantly comparing the effort of volume with the result of price, a Wyckoff analyst can gain a deep, real-time understanding of the true balance of supply and demand, often seeing signs of a trend's exhaustion long before it becomes obvious to the general public. These three laws, combined with the mental model of the Composite Man, form the complete intellectual foundation of the Wyckoff Method. Having established the foundational principles that govern all market movements, the universal law of supply and demand, the heuristic of the Composite Man, and the three fundamental laws of market action, we now transition from theory to practice. Richard Wyckoff's most enduring legacy is not just his philosophical framework, but the detailed, practical models he created for applying it. He understood that the campaigns orchestrated by the Composite Man were not random. They followed a repeating, logical, and identifiable structure. He dedicated years to studying these campaigns on the ticker tape, deconstructing them into their constituent parts and codifying them into what are now known as the Wyckoff market cycle schematics. This is where his method transforms from a philosophy into an actionable trading methodology. He provided a roadmap, a detailed anatomy of a market campaign that allows an analyst to identify the current stage of the market cycle and anticipate its most probable future direction. This section is a deep dive into that roadmap. We will dissect, step by step, the two most critical phases of this cycle. The accumulation phase, where the foundation for a new bull market is laid, and the distribution phase, where the seeds of a new bear market are sown. By understanding this structure, we can begin to see the market as Wyckoff did, not as a chaotic series of price swings, but as a carefully unfolding process of preparation and execution. The first step in building any successful system is building the habit of disciplined study and observation. The principles discussed here are not abstract theories, they are the foundational laws of market behavior. Mastering them requires reinforcement and a commitment to lifelong learning. If you are serious about developing the habits necessary for success, subscribe to this channel and click the notification bell. Let this be the place you come to forge the intellectual framework that will define your future in the markets. The process of accumulation is the most critical and often the most difficult to identify in real time. It is the phase during which the composite man, the large informed operators, patiently and quietly absorb a large line of stock from the uninformed public. This process does not happen overnight. It is a prolonged campaign that unfolds over weeks, months, or even years, and it almost always occurs after a significant and often painful preceding downtrend. The public, having been battered by losses during the markdown phase, is psychologically exhausted. Their sentiment is one of despair, fear, and disgust with the market. They are eager to sell on any small rally simply to get their money back, or they are forced to sell in capitulation at the lows. This environment of pervasive pessimism is the ideal hunting ground for the composite man, who can absorb large quantities of stock with minimal impact on the price. The entire accumulation phase is designed to transfer shares from these weak hands, the emotional and undercapitalized public, to strong hands, the patient, well-capitalized and informed professional operators. The Wyckoff schematic for accumulation provides a detailed roadmap of this process, broken down into 5 distinct phases labeled A through E. Phase A is the period where the preceding downtrend is finally brought to a halt. The selling pressure, which had been dominant, begins to exhaust itself and the first significant signs of large-scale buying emerge. This phase typically includes 4 key events. The first is preliminary support, or PS, where a notable increase in volume is seen after a prolonged down move, signaling that large interests are beginning to test the waters. But this initial buying is not yet strong enough to stop the decline. The downtrend continues until it reaches the most dramatic event of the entire accumulation phase, the selling climax, or SC. This is the moment of maximum pessimism and public capitulation. The price often plunges downwards on a wide spread, accompanied by a massive climactic spike in volume. It is a moment of pure panic, where the last of the weak hands are flushed out of the market, selling their shares for any price they can get. It is at this precise moment that the composite man steps in with immense force, absorbing this massive wave of selling. The result is that the price, after hitting its extreme low, often reverses and closes well off its lows for the day. This is the first clear evidence that a major transfer of ownership is occurring. Following the selling climax, the intense selling pressure is temporarily exhausted, creating a vacuum that allows the price to rebound sharply. This is the automatic rally, or AR. The height of this rally is significant because its peak will often define the upper boundary or the resistance of the subsequent trading range. After the automatic rally, the market will typically drift back down to retest the area of the selling climax. This is the secondary test, or ST. The character of this test is critically important. A successful secondary test will occur on much lower volume than the selling climax, providing the first strong evidence that the supply of shares for sale has been significantly reduced. The downtrend has been stopped, and the boundaries of a new trading range have been established between the low of the SC and the high of the AR. Phase B is the longest part of the accumulation process. Wyckoff termed this building the cause. During this phase, the stock trades sideways within the established range, often for a very long time. This period is characterized by a general dullness in price action and relatively low volume, as the composite man methodically absorbs the remaining floating supply of the stock. He buys on weakness near the bottom of the range and sells small amounts on rallies near the top of the range to test the strength of the remaining supply without driving the price up prematurely. For the average investor, this phase is frustrating and boring. The stock seems to be going nowhere. But for the Wyckoff analyst, it is the most important part of the process. It is the period where the cause, the accumulation of a large position by informed operators, is being built, which will lead to the eventual effect of a major markup in price. Phase C is the final test of the remaining supply before the markup begins. It often contains a decisive event known as the spring or a shakeout. The spring is the Composite Man's final masterful act of deception. It is a sharp price move below the established support level of the trading range, a move designed to mislead and trap uninformed market participants. This break of support accomplishes three things simultaneously. First, it creates the impression that the downtrend is resuming, inducing the last of the fearful longs to sell their shares. Second, it triggers the stop-loss orders of traders who bought within the range. Third, it entices aggressive short sellers, or bears, to enter the market, believing they are capitalizing on a new breakdown. The Composite Man then uses this artificially created liquidity to absorb the last available shares at bargain prices. The definitive characteristic of a true spring is what happens next. The price does not continue to fall. Instead, it quickly and decisively reverses and closes back inside the trading range. This rapid reversal, often on increased volume, is the ultimate confirmation that the supply of shares below the support level was minimal, and that the move was a deliberate maneuver to clean out the last of the weak hands. The market has been tested, and it is now ready to move higher. Phase D marks the beginning of the new uptrend, the period where the stock finally moves out of its long consolidation. This phase is characterized by a clear and sustained dominance of demand over supply. The stock begins to rally on widening price spreads and increasing volume. A key event in this phase is the jump across the creek, or JAC, which is a decisive move above the resistance line of the trading range. This is the first major sign of strength, or SOS. Following this initial breakout, the market will often experience one or more low-volume pullbacks to test the old resistance level, which has now become new support. This pullback is called the last point of support, or LPS, or a backup to the edge of the creek, BU. This is the final, low-risk opportunity to initiate a long position before the main advance gets underway. The stock has proven its strength by breaking out, and it is confirmed that supply is exhausted by pulling back on light volume. Phase E is the final phase, where the new uptrend is clearly established and begins to attract the attention of the general public. The stock moves decisively higher, and the path of least resistance is now clearly upward. The Composite Man's campaign of accumulation is complete, and the public now begins to participate, driving the price to new highs. The Wyckoff analyst who correctly identified the preceding phases is now positioned to ride this trend for a significant profit. After the markup phase has run its course, the Composite Man begins his next campaign, distribution. The process of distribution is the mirror image of accumulation. It is the phase during which the large informed operators methodically sell or distribute their large holdings to the uninformed public. This process always occurs after a significant and often euphoric preceding uptrend. Public sentiment is now the polar opposite of what it was during the accumulation phase. Investors are optimistic, greedy, and suffering from a fear of missing out. They are eager to buy, convinced that the trend will continue indefinitely. This environment of rampant bullishness is the ideal selling ground for the Composite Man, who can now unload his massive position at inflated prices without depressing the market. The entire distribution phase is designed to transfer shares from strong hands back into weak hands at the top of the market. Phase A of the distribution phase marks the point where the powerful uptrend begins to lose momentum and the first significant signs of supply emerge. This phase typically begins with preliminary supply, or PSY, where a sharp rally is met with a notable spike in volume, signaling that large operators are beginning to take profits. This initial selling is not enough to stop the trend, which often continues to a final climactic peak. This peak is the buying climax, or BC. It is the mirror image of the selling climax and represents the point of maximum public euphoria. The price often surges upward on a wide spread, accompanied by the highest volume seen during the entire uptrend. This is the moment when the last of the eager public buyers stampede into the stock. The Composite Man uses this massive wave of demand as the perfect opportunity to unload a significant portion of his holdings. The telltale sign of a buying climax is that despite the climactic volume, the price makes little further upward progress and often reverses to close well off its highs. Following the buying climax, the intense buying pressure is temporarily exhausted, leading to a sharp decline known as the automatic reaction, or AR. The low of this reaction often defines the lower boundary, or support, of the new distribution trading range. The market will then typically rally back toward the area of the buying climax on diminished volume. This is the secondary test, or ST, and the lower volume signature confirms that the buying demand is beginning to wane. Phase B is the period of building the cause for a subsequent downtrend. The stock trades sideways in a volatile, choppy range. During this phase, the Composite Man is methodically selling his remaining shares. He sells into the rallies or upthrusts that test the top of the range and may even buy small amounts on declines to support the price and maintain an appearance of strength. This creates a confusing two-sided market that churns through a great deal of volume with no net upward progress. For the Wyckoff analyst, this churning action is a major red flag, a clear sign of institutional distribution. Phase C often contains the final act of deception before the markdown begins. This can be a climactic event known as an upthrust after distribution, or UTAD. The UTAD is the mirror image of the spring. It is a sharp price move above the established resistance level of the trading range. This move is designed to trap the last of the bulls. It triggers the buy-stop orders of breakout traders and convinces emotional investors that the uptrend is resuming. The Composite Man uses this final burst of artificial demand to sell his last remaining shares at the highest possible prices. The definitive characteristic of a UTAD is that the breakout fails. The price is unable to hold above the old resistance and quickly falls back into the trading range, often on a wide spread and high volume. This is the ultimate confirmation that a massive supply of stock exists at these higher levels, and that the market is now in the hands of the sellers. Phase D marks the beginning of the new downtrend. The stock shows a clear and sustained dominance of supply over demand. A key event is a decisive break below the support line of the trading range, known as a major sign of weakness, or SOW. Following this breakdown, any small, low-volume rally back up to the old support level, which has now become new resistance, is known as a last point of supply, or LPSY. This is the final, high-probability opportunity to initiate a short position before the main decline gets underway. Phase E is the final phase where the new downtrend is clearly established. Panic begins to set in, and the public, who bought with euphoria at the top, now begins to sell in fear. The path of least resistance is now clearly downward, and the markdown phase accelerates, completing the market cycle. The enduring legacy of Richard Wyckoff is that he provided a logical and coherent framework for interpreting market action. He was not an inventor of a magical black box indicator. He was a master observer and a brilliant educator who systematized the timeless principles of the market. His work teaches traders to stop forecasting and to start analyzing, to stop guessing, and to start reading the evidence presented by the tape. The Wyckoff Method provides a way to understand the market not as a series of random events, but as a series of logical, repeating campaigns orchestrated by informed professional interests. It teaches the analyst to identify the footprints of this smart money during the quiet accumulation phase, and to recognize their selling during the euphoric distribution phase. In doing so, it provides a powerful methodology for aligning one's own trades with the dominant market force rather than becoming its victim. While today's markets are faster, more global, and more influenced by algorithms, the engine that drives them remains the same: the human emotions of fear and greed. These emotions are what create the patterns of accumulation and distribution that Wyckoff so brilliantly decoded. His method, therefore, remains as relevant today as it was a century ago, a timeless masterclass in finding structure in volatility.